So very quickly, without wasting much time, um, today, I have the honor of having my MD in the person of Mr. Bamdeligi on this call. I also have someone who I like to refer to as my Oga, Mr. Fatai Ashimi from PAC Research on this call today. And PAC Research is going to be doing a lot of justice to this session today. And I'd like us as individuals, as investors, prospective investors, to grasp as much as we can. As we know, 2025 has been not dynamic. There's been lots of shift policies here and there. So this session is going to provide us with a lot of clarity that we need to hold on to our investors. Once again, say thank you to everyone who has joined thus far, and we hope that you have an engaging session. So I'm handing over to my Mr. Bamdili to just put us through on some welcoming notes. Over to you, sir.
Right, Debbie, and good morning to you, everyone. Welcome to this webinar from the PAC Asset Management team. It's a pleasure to have you here, and we hope that by the end of this seminar, you would have gotten some insights into how we think the economy would run for the next half of the year, which we're already into. But I mean, before I hand over to the man who will anchor the economic review and outlook of this presentation, I'd like to just, remind us of some things that have happened year to date in the Nigerian economy. And, I will I'll start by referring to some of the outcomes that we've seen in half one of the year. The first outcome has to do with inflation. There's been a very slight decline in inflation in the first half of the year. Not what we all expect or we hope for, but ultimately it's a good sign showing that some of the economic actions, the actions being taken by the present administration is beginning to bear the expected fruit. You will also have observed that by the end of the first half of the year, the Naira has strengthened a bit against the USD. Again, I think that is partially responsible for what we have seen in terms of pump price of petrol in the market and, some effect on the inflation that has reduced a bit marginally. You will also observe that oil prices, somehow, they went up and then they went down. I mean, the decline in oil prices is not so favorable to us, but of course, we expect that we will be able to pull through regardless of what is happening in the oil sector by diversifying our economy and making sure that we can make effects from other sources. That is still a far cry, but of course, it's something that our government is really paying attention to. The stock market has really showed some kind of strength in the first half. You see a lot of banks, a lot of companies too, reporting very good-looking financial results in the first half of the year, and we expect that this will continue in the second half of the year. Money supply has sort of declined in this first half of the year as well. Manufacturers index, that has also declined. MPR has remained stable throughout the period, but we expect that once inflation is trending lower, the CBN might be compelled to take some action in that space. You will also observe in the fixed income space, treasury bills and bonds that as we speak now, the yields have started to compress. That may also account for what we're seeing in the stock market, where people are beginning to rotate their investments out of the lower yielding treasury bill fixed income space into the stock market, where they feel that, look, we can really get the kind of returns that beat inflation. I will not want to expose too much, and I'm going to yield the space now for Mr. Fatai to go ahead and make his presentation. I understand that we're starting slightly behind schedule because of technology challenges, but I would now yield the floor to Fatai Ashimi for his presentation. Thank you very much for joining us. So Debbie and Fatai, over to you.
Very much, Mr. Bamdele, for that insightful welcoming note. So well, this is the moment, and I'd like us to all close our attention to this next session. So I have the pleasure of welcoming to take us on this session Mr. Fatah Ashimi, who is the head PAC research. Thank you very much, sir. You have the floor.
So now, but before I go into the data and statistics, so I was wondering, I mean, because people come and attack us and say now data you go chop. I don't know, for those of us that actually live on the other side of Lagos State, when I mean by mainland, because I want to ask a question, if anybody has taken note of anything. I don't know, 1 or 2 persons can actually raise their hand and give me an answer with their observation. Third Milan Bridge is about 11.5 kilometers length. And in the last 2-3 months, I've noticed some things happening along that bridge. I don't know, is there anybody here that can hazard a guess of what that development is that has not been like that in the last 6, 7, 8 months? For those of us that apply that to the road, Third Milan Bridge, the entire stretch, in the last 3 months, and bear in mind that this is not political error, you notice that from the beginning of the Third Milan Bridge to the end, there's billboard of one company or the other throughout the length of that road. Yes or no? From from banks to manufacturing companies to car sellers and the like. What does that mean? That means something is happening. If you see companies spending money on promotion, try to let people know what they are doing. Then it's an indicator that there's a business expansion and everybody's actually struggling to have their own share of that pie. So with that background now, Nigeria is a place to be at this point in time. And whether as an investor or as a businessman, it is really happening. And money is being made everywhere. So that is, I mean, that's a rough estimate of what idea of what we're about to discuss today. So if you see, even those large billboards that have never been, on for a while, that are powered by either by generator, you see all everywhere. I mean, there's a big one by one bank, middle of that sea, where you see the name display everywhere from the beginning to the end. You see display of a business billboard, either as a bank or whatever. That tells you that there's increased activities. Now let's now go to the report presentation, where we try to put things together in proper perspective, bearing in mind that we have different caliber of people here. Not everybody here is an economist, but we try to put in a layman languages that everybody will understand. Yeah, this is the table of content of our presentation. We are the first because this is a global economy, and whatever happens anywhere is affected everywhere. So we try to see what has happened in the last 6 months vis-a-vis the global economy, and what are those events that shape that perspective, and what impact does it have, and what does it mean for Nigeria. Then from there we move to Nigeria as a country, try to see, but trace further those data. The MD of PAC Asset Management have just shared with us, and the main thing, which is the financial market. What the activities there. Are people making money by bandits like a bandit, or are we really playing? Are we really entering into it with all our 2 eyes closed, or what? Then finally we look at what's the rest of the year hold for us, and from our point and the investment strategy. But I must say this from the onset. It's always good to actually try to play in market with people who can guide you. Because if you think you want to do what master of one and everything, That's why people, running to an institutions like a PAC Asset Management at this point in time won't be a bad idea completely. So on that note, let's take a deep dive into. So these are the key events that shape the economy in each one. Everybody is aware of when Trump came talking about trade wars, American first, and what have you. And that's a major event, and it has had a lot of effect on global trade. Then geopolitical conflict. As we're actually thinking of where Russia and Ukraine matter will die down, suddenly Israel and Palestine issue came up and become an issue. And the major thing now is the tech and artificial intelligence. These are become a major driver of global business, and it's becoming the talk of the town. So it's either you enter into it, or actually you left behind and get yourself to be blamed. And this is reflected in the shares of some of these companies in the stock market. They are actually, in fact, the appreciation they've had in the last 6 months is remarkable. So in summary, in the first half of the year, the global economy has had kind of surge in trade tensions, tech-driven market, geopolitical conflict, and inflation risk amid the global shift. How has this impacted the economic performance of the various economy of the world? Usually, the focus has always been on the advanced economy, because when they snitches, every other part of the world catches cold. So what have they fared? So despite all the challenges of this, we have seen some level of very huge growth rate in most economies. China leading, and Canada, Japan, United States, United EU area. And why do we pick those countries? These are the countries where they are trade partners with Nigeria, because whatever happens to those economies, so it invariably affect Nigeria and the economy as well, because they are either we export to them or we import from them. Whichever way you look at it, whatever affect them affect us. And if they are growing, it's as good as it will affect our economy in a way. I'm positively at that. Well, this is usually the life wire of Nigeria economy up till now, that we try to really diversify. And the oil market, like the MP said earlier, the price has been, up and down like a yo-yo. So started the year at almost over $80 per barrel, and currently at 68, which is still far below the budget benchmark this federal government set out to be. But the good news is that our production is actually going up. But don't forget, and this can be argued, Nigeria oil revenue is more, effect of price is lower than effect of production. And how do I mean? Production, oil price is just a unit of a barrel, just 82 or 68 as it is currently. But production is always in millions of barrels per day. So if oil price decline by 5% and production decline by 5%, the impact will be more with a decline in production than in price. So even if the price is declining and we are gaining, more by producing more, I think we are better off as a country. Not that the price is not as important as the production, but the impact of price falling is lesser than the impact of our production for declining. And luckily for us, there have been some positive developments in terms of production, so which we're likely to see because of this presentation. So these are, but the oil price, and unfortunately, why this oil price is to be important to everybody here is the fact that especially the oil and gas sector of our financial NGS, they always reflect whatever is happening in the oil price level. Whenever you see oil price coming down, go and check it out. There's tendency for that price of some of these oil and gas companies, the prices coming down as well. It has always been the trend on a regular basis. That has always been the case. Then inflation, though, we started at the year with high inflation rates, and to the extent that most countries of the world actually adopted strong monetary tightening. But over the years, because of those various policies have begin to have impact, and is easing out. So most of these countries have experienced a decline in inflation. Look at US, currently at 2.4 as against 4.1% in this period last year. And that tells you that, I mean, Nigeria is not just in isolation of whatever is, I mean, in isolation of not likely to be impacted by whatever is happening in other parts of the world. So the same way, but the fact is the prices still remain highly, I mean, sticking upward, because in instances, some of these geopolitical tensions, where we have some of food items and trade restrictions causing prices to remain. But I think prices are coming down across board and beginning to have that impact on prices of prices of capital, which is the interest rate. Don't forget, I mean, they are the tendency that if interest rate is higher in advanced country, that will affect our own market because of the risk element of it. So in summary, how has all this impact Nigeria? We say prices, I mean, whatever we do, that's where we get our strong dollar revenue from. So it goes up, our revenue goes up, but luckily for us, because of the exchange rate effect and some other non-oil services contribution. So the allocation to the various tiers of government in the last 6 months have been very, I mean, has gone up. In fact, for the first time, almost 2 trillion was shared for the month of June, and that is really massive. And we have never had it that good. But the question is, if we actually discount inflation from that, what value are they getting? But no doubt about it, they are getting more in terms of growth moderation and trade extension. The positive impact is there. Financial market volatility, especially the tighter U.S. immigration, and where we used to have the diaspora money into the country. This has effect, but maybe because, I mean, some of them may have to find their alternative way of doing things. But the good thing is that when I look at the inflow into the Nigerian NGS in the last 6 months, in the month of May, actually inflow from no, that would be from portfolio investors, actually more than double, and that was the first time we have more money from foreign investors than domestic investors. So if you have to strike a balance, the positive of this global effect on Nigeria is more than the negative effect, and we are feeling that in our various macroeconomic indicators. Now let's go now to the economy. Well, it's no longer news that this NBS actually released the official data for rebasing the economy using 2019 as that base year, and it's becoming it's normal thing in globally. It's not just only in Nigeria that happened, because I know everyone to see. I mean, it's just like playing with mirror. Not only playing with mirror, because what get measured get done. If you don't properly measure your economy, how do you know which sector of the economy you have to focus on? So, and that has actually added at least a third of the GDP back to our GDP size, from about 230 to almost 300 $200 billion. But the question is, I mean, this government said they are targeting 1 trillion economy in 2030, or 2031. But with this, at this pace of growth rate, are they likely to get to that level? Well, your guess is as good as mine, but at least there's some level of improvement. But to actually see the real impact of this rebasing, not necessarily in terms of the larger size of the GDP, look at the bar chart below by the right, you see that where you try to break down oil sector versus oil sector. In Q1 2023, non-oil sector accounted for almost 94% as against 6.2%. Q1 2024, 93 as against almost 6%. But with this rebasing now, we now have 96% for non-oil sectors, and oil sector account for just less than 4% of the economy. That tells you where activities are. But we'll get to the next slide. We see those areas that, I mean, those sectors of the economy that actually contributed more to this GDP, and that can actually give us a picture of where Nigerian money is. Because in layman's language, when they say GDP is just the monetary value of the goods and services produced in the economy within a particular period of time. I mean, usually in 1 year. So, but when you see some sectors getting more of the pie in terms of total pie of the GDP, that tells you that that's where the money is going. And smart investors and businessmen, those are the areas that they actually need to focus on. At least if this sector is getting this much, then that means some people are actually going there to make that sector with the opportunity they're in. And here we go. You see, this is the breakdown of the GDP. Based on this base GDP, the top contributing activities to the GDP in quarter 125 is trade. And before now, because I used to say this to many people in our various discussion with my colleague, Nigeria is a trading economy. There's nothing, because we are not producing. If we don't produce, I mean, everything we just go and either import and sell, or the little things we can manufacture, we don't process, just bring to the market and sell. So trade now is contributing about 18%, and that tells you where the real activities is. I mean, trading is huge, and if you say almost one fifth, if 1/5 of Nigerian GDP size of $300 billion, that tells you how big that trading is. Because Nigeria is always, we like buying things. Everybody's buying one thing or the other. Well, so crop production is taking shape because there have been massive investment in agri, and there's, I mean, because of the fact that majority of our food items we consume in Nigeria, there's always a supply gap because demand is always higher than what we consume. So that's where don't be surprised if you see the Pesco of this world, the Okomo of this world running the way they are running. I mean, if somebody, I mean, a friend just called me the other day that, wait, not that he didn't just buy just invest newly. He entered Resco at less than 300. And when I look at the market yesterday, the market closed at over 1,000 naira. I say, wow. But I mean, not that everything is going that direction, but there are some of this that you can. Now the real estate, this is where the real interesting, this is where the game is really on. There's this general assertion that Nigerian housing deficit is, I mean, the figure varies. Some say it's 18 million, some say it's sorry, I want to spend some time on this graphic because that gives us a sense of where we can, I mean, as an individual, not necessarily that's for financial market investment, because that's where the money, business activity is going on in Nigeria. That's why I'm taking my time to explain this slide. The real estate, that is where some said our deficit is 18 million, some say it's 27 million. I mean, based on our own report we did recently. But I mean, Nigerian population, almost 50% of every activity is taking place in Lagos. And if that is the benchmark, and the general assumption is that less than 20% of Lagosians are landlord, 80% of Lagosians are tenants. So that tells you something. So people, is anybody looking to talk or what? Can I go on? I can see your hand rolling.
Please go on, sir.
Okay. So the real estate with that huge, and a lot of things happen in real estate that's happening, that's supporting the growth in that sector. Not only that, I mean, because one is a place where some money laundering activities can take place. I mean, I can be pardoned. This is only a sector where you can do everything by cash without anybody, I mean, getting to know where the money is coming from. You can build a multi-story building by cash without going anywhere to pay for everything except some government permit and what have you. So that is it. And a lot of other things that's happening is making this happening, and things more happening in real estate. I mean, last year we all experienced what we call dirty December. And I mean, just like what is happening abroad, where people will have to leave their house at a point so that they can do a sublet and what have you. And that is really going to magnify because celebration of festivals in Nigeria is becoming a major thing. Look at what happened in Ijebu during their video. But what my analysts that covered that sector, I mean, reported that over 2 billion naira, I mean, support was gotten them from promoters. I mean, those who fund them, who promote, who really back that activities. And it's because it was a talk of the town. And I'm quite sure the real estate in terms of the hotel and what have you, related activities like hotel and housing we get magnified, and that will continue to be the same thing. I mean, if everybody is like things happen, we just get quiet until it's about to happen again, and it's about time people plan ahead for the next edition. With experience of what we had in the 30 December last year, I can assure you that, I mean, those people I mean, that neighborhood of where activities is taking place, whoever real estate there, this is the time for them to actually, cash more, get more cash and get. So it's a target and it's an area people can. So down the line, across this value chain, where the usual financial institution is not left out. But thank God, before now, banking is used to be the dominant player in financial services. But until now that we have other non-banking financial service provider like PAC by PAC Asset Management and the like, and they are all they are major contributors. So we now break down by sector that grain cost or quarter on quarter based on this. We have raised transport and pipelines. That's understanding because they are coming from low base, metal of low base, electricity and the like, and oil refining for obvious reasons, and because Dangote and is coming in and with a and that has actually released alter the demand supply dynamics of refined petroleum consumption in Nigeria. Well, there are some laggards in terms of those who are actually declined. The regulars, the manufacturing is still struggling, and I think with time, if you can get power right, and with inflation coming down, so I think that's so by and large. This slide is a slide that we can actually, take the whole day to discuss, but it's now left for us as an individual, because this is also reflected, this slide you see here is already reflected in what is happening in Nigeria Stock Exchange. And by the time we get to that stage, we discuss further. I hope I'm being heard.
Yes, you're being heard.
Okay. Now, the inflation rate, this is the big elephant in the room. Everybody is complaining about their purchasing power. Their salary, their take home cannot take them anywhere anymore because of eroding purchasing power. And I don't think salary is increasing at the same pace inflation is increasing. So there's some moderation in recent times. Some attributed it to rebasing because remember, the first rebasing was based on the consumer price index, where they actually factor in more of things that happen. Before now, it was assumed that 50% of one salary is spent on food, but I may be corrected, but I don't think not many people here will spend, especially middle level, if there are still any level like that, who are the top, where they spend 50% of their income on food. So that means the representative basket of where they used to actually monitor inflation in Nigeria says 52% of the DAI index is on food and other, but the critical things that actually consume, a typical household spend their money on. One is transportation, housing, and education. Those are, food is important too, but I think those, it's now come as one of the third group. And surprisingly, some states are actually there's diversity in the, because all we have, when you see if you go like 22% or 20-something percent inflation rate, it's just the aggregate. It affects various parts of the economy differently. Some states have like Ebonyi, Borno, Bayelsa. Those are the worst hit. But and state like Katsina, Adamawa, Sokoto, I just want to have at least inflation rate in during the half year. Though the outlook is there, we're going to look at that, but we see that moderating. But because one thing has has really helped the inflation, because inflation is like this during the planting season, because though the harvesting is almost coming in, then you can be assured that the effect will be more felt when the harvesting is taking place. Because the only harvesting I see now is corn. Everywhere you go, you see corn, and some other food item. Though I understand new yams are coming to the street, but when there is full harvest, when we get to August, September, we will begin to see but the challenge has always been, most things when they harvest them, no way to preserve the price affect the price, and before you know it, just like a law with pepper and tomatoes and like. So inflation remain high at 22, but it's not where. Remember, at the point we are at over 30%, and I don't think we can ever get to that level in the next 6 months or thereabout. Interest rate, where the MPs, in an attempt to actually, curtail the rising in price level. What does this central bank adopted what is called inflation targeting, and what they do is just to ensure that the real interest rate is not negative. And what is real interest rate? Real interest is the nominal interest rate minus inflation rate. So at a point when inflation was at 30 something, so they increased up to 27.5%, and so that it can close the gap. But today, interest rate is 27 and inflation is at 22. That means the real negative rate, the real interest rate is now positive, which is good for investment and investors and investment environment. Well, the trend is not totally similar from the African peers, whether Ghana has come down to some level. Nigeria is still 27.47, but it depends on the direction we see inflation going. But the signal already shown, because TB rates, being shown in recent times are really the price. The clearing rate is becoming lower, which means investors are getting less in that year. But even if they get less and the inflation is coming down, so that means the real interest rate can still be positive. The foreign exchange. This because it has become interesting. So to some extent, we want to commend the government for taking that hard decision, the hard policy initially in the last 2 years, and we have seen some level of stability in this rate, especially this year. I remember one of my colleagues in the office that this time last year, he came to me, he said, "Oga Fatai, where this Naira will cross 2,000. I said, "No, it won't get that. You shouldn't worry." And at a point, I was afraid, maybe I'm not going to lose that bet. But we get to 1.8, and luckily it came down. Though coming at a price where our reserves, once in a while, but still our gross reserve at 27 is still one of the best, good ones among his peers. But there'll be stability. And what this means is that it makes businessmen plan well, and so that they are sure that if they buy their stock today, whatever when they go back to the market, they are sure with the same level they have to replace their stock is not going to be a concern. And the good thing about this is that because now there's less pressure on FS for people who want to put in terms of discretionary, put as an investment outlet. And that's why you see banks now try to say your Naira card can be spent to buy for e-commerce because you can use Naira to pay. Or that has been suspended for a while. So there's less pressure, and you see this changing. It's not likely to happen for the rest of the year. This trade balance, here we talk about our export and import. Well, you look at the right-hand side, we have the graphs of our import and export. It's both almost doubled in the last 1 year, and the effect is because this is in Naira, is the exchange rate effect. But we shouldn't lose sight of what the impact of Dangote refinery is, because not only are they getting supply local market, they're actually exporting refined petroleum to other parts of the world. Though, there was a call by businessman, we always want more, that they should actually ban fuel importation, importation. But if you have my opinion, so I think it will be too early, though it's a thing that would have to be done at a point in time, because you can't have all this huge investment, but to avoid some other negative grid effect of either being monopoly or monopolistic tendency. I think but the positive effect has been really positive, and that has been reflected in our balance, our current account balances, and that is good for, that's the positive again for our exchange rate. So that has been about various macroeconomic indicators. Now let's go to the financial market, where I think the interest is, because our hosts today, they are into this, and I think people want to let them see how they really feel. This is the trend of the ASI in H1, and it's been very interesting. It's been growing. If you look at it quarter on quarter from the table below, Q3, it was a decline, minus 1.5, Q4 positive 4.43, Q1 2.67, and Q2 13.54. So that means, I mean, for the half year 2025, the market has gained about 15%. So, and if that is annualized, you know what that means. So what that means that even if you enter with 1 million naira, you'll have gained close to almost 150,000. But remember, in July alone, the market has gained, okay, the 16% half year. In July alone, market gained 14.95%. Year to date, H1, market gained 16.57. But in July alone, market gained 14.95 alone. That's quite interesting. And if you compare what we have with some other markets, Nigeria is one of the best performing markets in terms of equity market. And I'm quite sure all this will be reflected in the fund, I mean, PAC Asset Management equity fund. I'm quite sure for those of the customers who are here, you know that there's a good return from that. And it's across sectors, except oil and gas that has been, I mean, because of the impact of this global development. So it's been positive, and we see this continue for the rest of the year. For if a closer look at it again, for those who are really look at fundamentals and who are really into technical analysis, you see that whatever we are seeing in the market today is reflecting what we experienced in 2023, where the market closed at 45%. So it's just following that trend. I mean, look at that technical analysis of that market. So if year to date we are at 33, we are at about 34%. So there's tendency, there's still room for some positive return. But the question is it time to realize profit? I mean, at least this we can be delayed, because whoever does that now to enter that market again will be at a big price. And don't forget, the market is seriously seeing some level of foreign portfolio investors who are coming in. And like I always tell people, when you see this hot money coming in, and remember, next year is a 8 year to election in Nigeria. So there's tendency that most of these funds will likely go back by on or before June next year, because by June, after June, everything is on better off, and every focus will be on political activities. But now, I think this trend is likely to continue for the end of the year. So we can see some positive, we can see them continue to make lessons from level of appreciation. But if you try to offload now, so how do we enter? That's a $1 million question. The bull versus the bear. These are imagine if you have somebody here that has some of these top price gainers. I mean, average of from over 400% to 157. You can see why the market is the way it is. See the average growth rate, I mean, increase in the prices of those gainers, and the average decline in prices of the losers. They are far mild apart. The highest in losers is less than 70%, and the lowest is about 14%. While the highest gainers was 414% as against 100. So these are real. I mean, the question is, if you compare this, where do you place your bet in the last 6 months? Are you part of those people who are in green, or are you part of the people who are in red? And if you don't want to need to avoid this, I'm quite sure our asset managers or fund managers like PAC management probably will be a party to the red lines. I mean, because they make their decision based on investment decision based on informed data and analysis. And people like us, I mean, we partner with them. So banking 18%, consumer goods across, but even insurance, industrial goods, and the like. So these are the top gainers. Money market, well, this is a market that's largely affected by the level of liquidity in the system, and because of the inflation target of central banks, they gradually adopted a tight monetary policy. But over time, because of level of inflation coming down, we've seen some some level of moderation in the yield, one market instrument yield. So, but they are still, on the average, between 18 and 20 something, which is still okay. But the good thing about this, you can't do if you to balance your portfolio, because this is an instrument you can convert to cash very easily. So it's the market that, but look at interbank rate of open buy back and overnight. So it's a market to watch, and it's one of the options for investors. Fixed income, easy monetary policy negative for yields. The MDs talk about this, if compressing yield in the market. So, but then it's still very, because of you balance your risk and your return. So this segment, the fixed income market, and that's why the CBN, DMO over some closed some bond yesterday, and the level of subscription was really interesting, especially for those long tenor fund bond. And the reason is not far-fetched when the situation where you expect interest rate to decline in the short term. So that means just enter into the long-term fund, so that when those interest rates are coming down, you have already locked in for a long-term money. So that would be beneficial. And those are the kind of decisions asset manager we have to take a look at. So anticipate what's likely to happen, and when there are opportunities to invest fund. But I think it's always good to monitor this. Euro bond, the CBN activity is actually dictating investor sentiment, and you can see the various from 5 year to 7 year to 10 years, and to our 10 years bond market. So we see the yield compressing and coming down so, because for as long as activity is going on that direction, that's what's to be expected. But this government, now that we have a bigger GDP, that has expanded their debt to GDP ratio, and they are given more leg room to borrow, and why we should expect that. But the question is, are they likely to muscle out borrowers, institutional borrowers are aside from government? I don't think so. And those ones who are actually borrowing, we see some level of activities that we probably want to report in the course of this. So basically, in terms of market everywhere, is good for investors, and the various alternatives are attractive vis-a-vis, whether in terms of real rate of return, because inflation rate is coming down, or where do we see it? But most importantly, what is past is past. What is important is what are we looking at for the rest part of the year. So this is the outlook. The first, because this is the major drivers of what happened in the financial market. So the inflation is a key factor. And like I said, currently at 22, so we are likely to see further down. Our projection is we may see inflation closing the year at 20-21%, because there can be a drastic cut in that. So, but in 2026, we may see some upticks again, because electronic spending and political activities may inject more money into the system, because politicians, you can't curtail them. They have to spend more money. But inflation at this level, so the yield, the interest rate level, maybe we see some moderation, we see some further 25 to 50 basis point cut or even at best, you can see MPR closing the year at about 25%. Interest rates, this is what we have just talked about. So if inflation rates continue to moderate as it is, and though when we look at the MPC communicate the other time when they are done, we all see that all of them unanimously posted that they should retain. But for how long will they do that? Just a matter of time. Q3, by the time inflation comes down further, they don't have any reason not to cut rate. And also, the other leg of it is the growth. The fiscal side of the economy wants growth to happen in the economy. So there could pressure from that side that they actually look at the possibility of. So for us as a fund investor, especially in money market or whatever, the longer we can lock in, the better for us. So in anticipation of this expected cut in interest rate. Fixed income and money market, there, the yield environment favor money market and bond market instrument. So giving us some effective yield of between 18. We expect it to continue to do at a moderating rate. So, and for our foreign lending costs, we've seen some commercial papers here and there attracting yield of over 30%. I'm quite sure, but there must be a caution here because not every papers you see you jump at, because you have to be very careful. Some could be a jump, but I mean, because it's just a tide that's lifting everybody. So everybody wants to really tag into that. So, but that would be still be more. It's attractive, but we have to cherry pick. So of those commercial papers, equity market, are we likely to see reverse of what has happened? No, it's not likely to happen now. So let's continue to enjoy it because at this pace is going. If in 1 month we pay 15%, who want to? If you exceed, how do you enter? So and the only way you can begin to see some moderations when these hot money people, foreign portfolio investors, but I guess, like I said, they are here till first quarter of next year because definitely by the time we begin to go into election, everybody, I mean, people that are not, they are more interested in their money. Those are about the time they, so already gained, I mean, recall that the equity market has already gained over 30% year to date, I mean, 2025. And if you can look at the technical analysis of it, if I say this market is mirroring what it did in 2023, 2023 it closed at 45%. So I will likely to get to that. I think there's a strong possibility. So that is it. So, but we have to be careful with this kind of stock. Is it a value stock or growth stock? But now that its market is, I mean, on this race, do you really want to see some growth stock? I mean, how many of this stock can still grow for that, except those ones when they begin to release their results, corporate results, because that will be a major driver for the rest of the year. So for those stocks that they can, but good enough. So some of the companies are listed offshore, and those ones, I mean, you have to convert the naira and the pounds or euro to see where you want to click. So whether here or there. So which one will benefit you quickly. So here we go. So what are the various options available for us for the rest of the year? Fixed income, I mean, we still have to, it's a good play. So, because I mean, there's no way, for as long as government continue to borrow, because some of the excess funds, you can't put all your egg in one basket. You can't continue to do either equity or this other alternative. But at this level, we still have to do some selective equity investment, both local and global equity market play. Because, I mean, not many Nigerians actually look in this direction. And especially the tech companies in the advanced country. I mean, I look at the US NASDAQ market closing yesterday, and I look at the way some of these tech shares are actually jumping. Diversifying into other currencies, I mean, there's no way, I mean, especially for the HNIs, it's a portfolio. I'm sure PAC Asset Management have a dollar mutual funds, and their return is one of the best among their peers. I mean, though, I mean, there are others, there are some that are well above them for obvious reasons. So, but I mean, they are not far below. They are mid player. But definitely it won't be a bad idea to go into that. So, and in all of this, we still have to ensure that we make room for opportunistic investment. Cash is king. Things that invest in things that can collapse, and especially in money market, where you can take capitalize on bargain and imagine opportunities. Because the opportunities always come one way or the other. There are some investment that will come that I mean, so even if your fund managers can actually put this some money in either on call or money market instrument that you can convert for those opportunities when they arise, because you can't if you don't put, and remember that the various motives for keeping money. One of them is transactionary, precautionary, and the other noise. So you have to track a balance to ensure that. But cash is king here. Not necessarily put the cash under your bed. But I mean, if you talk to your fund managers about to relocate, put some portion of your money in the way that you can call it anytime you need it. I think they know where to put the money. Ladies and gentlemen, I think we have come to the end of this. So thank you for listening, and hope I've been able to share some my thought and deliver this work. Thank you.
Hmm. Thank you very much, sir. Would all agree with me that it's been a very insightful session with Mr. Fatai Ashimi, the MD of PAC Research, and we would agree that he has shed a lot of light on what happened during the first half of the year 2025, and what we should be looking at during the second half of the year. It's been a very insightful session. Thank you very much for this. So I'm sure we have a lot of questions, but while we are putting together our questions for him, I would want to welcome the MD of PAC Asset Management Limited to just run us through, as investors, I'd mentioned earlier that Mr. Bamdele is renowned in this field as an investment manager, and he'll be talking us through what he thinks, how he feels investors should position their finances, to be able to position themselves or ourselves for what is going to happen the second half of the year in terms of placing our investments, or what we need to do with our funds. So sir, we're happy to hear from you. Thank you.
All right, thank you very much, Debbie, for calling me up for this session. And I'm going to say a big thank you to Fatai Ashimi for a very high quality presentation that he's given us. So of course, without much ado, I'll just go into what Debbie wants me to respond to. Now, so a number of things here. We need to begin to look at what are the tactical portfolio adjustments that we can make, the defensive and growth focused strategies that we can adopt, and financial planning considerations for half two. So, I mean, when we speak about tactical portfolio adjustments, I basically will start with the equities portfolio. And if you ask me, we all see how the market has performed in the past few months in terms of the returns on the equities portfolios. I mean, you see some returns reaching over 1,000% in a short space of time. And so you will ask me, what steps do I have to take? Yes, while some of those companies that have really reported superlative returns in a short space of time, they remain high quality companies. It is not out of place for you to take some profit. I mean, take profit, take profit, take profit, take some profit from those positions that have given you superlative growth. You might retain some bit of those portfolios for them to continue generating returns for you. But take profit by all means, and make sure you look at other growth areas in the stock market where you can invest whatever profits that you have taken. I mean, I think I actually saw one question in that regard in the Q&A session of the of this webinar. So I think that basically answers the question from Mr. Jimo, that points to the fact that, look, some of these stocks have had very high returns. What do we do? Take profit before they disappear. Of course, that leads to the question of what is driving this performance in the stock market. Part of that is being driven largely by monies, FDIs flowing into the economy. As you may have known by now, there's been some FDI inflows, and whether you like it or not, as Fatai has pointed out during his presentation, once you hit election year, some of these monies will find their way out. And when that happens, you're going to see that some of these valuation gains in the equities market might moderate. So, I mean, the tactical move to make is, closer to the end of the year, you can take profit and, keep whatever gains that you have reported. And of course, that also tells you that if you're taking profit in that space and there is a prospect that hot monies will take flight, then consider some level of FX accumulation. Because of course, we've seen what has happened in the FX space now, that the exchange rate, the Naira exchange rate against USD has strengthened a bit. It might be a good time to buy so that once you begin to see a reversal of the situation, you might also get some gains from there as well. Now, I'll quickly speak to the fact that of the defensive and growth focused strategies that you can take. Whether we like it or not, so we have to take some global perspectives into consideration here. The U.S. president, for instance, recently gave the Russian president or the Russian nation an ultimatum of 15 days to end the war in Ukraine. And I don't think, I mean, this is just my opinion, I don't think the Russians are going to listen to an ultimatum from another nation's president. They see themselves as sovereign nations. And that tells us that, look, there might be trouble, some form of trouble brewing on the international scene, and we don't know how far this will get. We hope it doesn't go that far to the point that they attack each other. If they attack each other, it's going to have global consequences, a lot of disruptions in the global supply chains. And so we need to put those things into consideration. For us, largely in Nigeria, it might, I mean, if that happens, it might result to higher oil prices, which is a benefit to Nigeria, to the Nigerian nation. But of course, what it also translates into is the fact that pump price of petrol might also go up because, of course, we're working in a deregulated market now, and whatever happens to oil prices should have some form of effect on our pump price locally. Now, if that happens, that also tells you that you also need to, I mean, consider the oil marketers. You should consider that in your portfolio. That look, something might be in the might be going up here. And of course, we have a few healthcare providers in Nigeria. We should consider those kinds of positions for our own portfolios as well. Of course, you know, whatever goes on, whether there's war, whether there is peace, there will always be healthcare. People always need healthcare, and more so when there is trouble on the global scene. You might find that there's more requirement for healthcare products, healthcare services. Of course, let's not forget about the manufacturers. Whether we like it or not, if the economy is getting better, that also means that our manufacturers around here might be gearing up to increase production. If they increase production, then they increase earnings, which may translate to into their P&Ls, which helps our economy as well. And of course, it's good for the markets that we have producers. And of course, without, we would not forget the financial institutions, because they power most of these funding requirements in the markets. I mean, manufacturers will need funding, whether by commercial papers or by bank loans. And of course, they route that through financial institutions, especially the banks. And so we cannot underestimate what will happen in that sector, because they're poised to take advantage of most of the positive developments that we hope for in the market. And of course, in terms of planning your portfolio for the future, we'll speak to the fact that, look, you always, I mean, we've seen what's happened in the past in terms of the exchange rate and so on. It's important that you have a component of your portfolio in foreign currencies, and so we will recommend that you maintain some portfolio component in foreign currencies, the euro bonds. Now the question is, if I'm playing in the euro bond market, where do I play? Do I play in the sovereign space, or do I play in the corporate space? in recent times, there's been more attention to the corporate space, and where we're at the moment in the market is that some of these corporate space instruments are beginning to trade at par or premiums, or maybe at the best at near par. But then we still have some discounted instruments have been available in the sovereign space. Of course, the idea would be, look, don't be exposed to the long-term maturities. Be exposed rather to the shorter-term maturities, so that if there is an unfavorable situation, you can quickly react and move back. And take corrective action as fast as possible. And finally, I'll speak to the fixed income space in Nigeria. The presenter has rightly said that we should, by all means, consider locking in some into some high interest or high yield positions now, in anticipation of the fact that the current high yield environment that we're seeing might soon disappear. As inflation moderates, that might go away. And if that goes away, if you've locked in now, at least you earn the same good rates for some time into the future. And of course, at that point, you can take other actions that are applicable at that time in the future. In summary, I'll just say, for all of these recommendations that we have put forth, we have products that speak to each of them. On our mutual funds, we have 5 mutual funds. We have the Euro Bond Fund, which is a dollar-denominated fund. We have the Money Market Fund, which invests primarily in the money market. We have the Fixed Income Fund for longer-term capital market investments. We have the Equity Fund, of course, which focuses more on the equities market. And we have the Balance Fund, which is a portfolio that tries to balance between, gives you almost equal exposure to the equities market and to the fixed income market. So you can talk to us, talk to our team. I'm sure Debbie would provide you details of how to contact us by email and other channels. So I will stop there, and I'll yield the floor for Q&A. Thank you so much.
Okay, thank you very much, sir. Would agree with me that we've covered quite a lot from today's webinar. It's been a very insightful session, and we want to once again thank all of our attendees today. We know that it's early in the morning, and for us to even be here shows that we have this at heart, and it goes a long way to show how much PAC Asset Management means to to you as our investors and our would-be investors. So we have a couple of questions here. So before we go on to give our closing remark, we just want to take a couple of questions here. So we have a question here. I think the first question from Adeyemi. Thank you for this. I think Mr. Dilly has spoken to it, but if you want more clarity, you can let us know. So we have from one person who says, can the Nigerian financial market sustain its current momentum amid persistent macroeconomic headwinds? So I don't know if this is speaking to Mr. Fatai. I think Mr. Fatai, I don't know if you'd want to take this. So the question is, can the Nigerian financial market sustain its current momentum? And, amid all of the things going on in the macro economy.
Okay, thank you, Debbie. Well, I'm just wondering what economic momentum this person is referring to. Basically, the major drivers of growth in financial system is financial market, is economic activities generally. Because, what is financial service? Financial service is aggregating funds from area of surplus to area and moving to area of deficit. And if most of the sectors in the economy are growing, that means there will always be demand for them to come back to these various financial service providers so that funds can be channeled to them. And when they are coming, that is more business activities for them. So at wholesale level, institutional level, the economy is showing some level of strength. And we likely see this going to for the rest of the year. That's what I said. The NGS, I mean, though there may be some level of flattening out in another 3 months because people want to enter now is a problem. But that is, I mean, is highly sustainable. I mean, there was a report from IMF yesterday that Nigerian GDP, they actually increased our forecast for the end of the year. It's the same IMF that actually lowered it in March. But as at the end of yesterday, they came out to say GDP, Nigeria growth momentum will be sustained, and we are likely to see more. Then lastly, when you are coming from lower level, it's always good, it's only easy for you to grow. Don't forget, this Nigeria economy has actually gone to almost 500 billion at a point, and we are currently at 300 billion. So what I know that because more Nigerians have left Nigeria, or more businesses are, I mean, people have most of Nigerian money have moved out of Nigeria. It's still within the system, just that the productive activity is not taking place. It's not, so first, just like as Daily said, activity is going on. That's what I started with, that example of billboard everywhere in on Tom Mainland Bridge. I don't know if people noticed that. If you see people board everywhere, that means activities taking place. I mean, I see car sellers selling their own. I see banks, even, I mean, the detergent people, Ariel or something. I saw their billboard. So if you begin to see all that, and these businesses can only be prepared, can only be, I mean, promoted through financial service system. So for the rest of the year, I think it's sustainable, and we should something we should all, I mean, position to benefit from. Thank you.
Okay, thank you very much, sir. So we'll take this one. I think this should be addressed by Mr. Dilly. So looking at the FX market at the current yields around Eurobonds, is the continuous global conflict expected to further impact returns, considering the downturn in yields that we've seen in recent times? So this person is also asking, would you recommend looking at the local Eurobonds or investing outside in treasury notes and alternative foreign assets?
Yes, great question. So I'll start from the latter part of the question. If there are global challenges, prospects of war or attacks of one country or the other, I'll be careful or cautious to invest in those economies that are at risk. You understand? I would be careful to invest in those economies because you don't know what would happen. You don't know what their capacity to pay would become. So I would recommend the home bias if you like. Let me call it a home bias, closer to home, where you understand the markets better, where you get the news faster. There's no time difference between you and Lagos. I mean, I assume that you're trading in Lagos, and you get the information as it happens in Lagos. For instance, if you were to invest in another economy where by the time the news hits the market, you're still sleeping, and by the time you wake up, everyone who needs to take action has taken their action, then you find yourself in a tight situation if things get out of hand. So my recommendation is consider a home biased investment, in FX or foreign currency denominated actions. But also note that look, whatever happens on the global scene, especially as regards the US, if you're investing in USD denominated instrument, will affect the Eurobond market. So keep an eye on that market for the news that affects that market. And then, but I think whether you like it or not, where we are currently, unless the something happens in the US, you find that, look, this current yields in the market will be sustained, especially in the Eurobonds market. These current yields will be sustained for some time. So I'll leave it at that. Thank you.
Okay, thank you very much, sir. So still to you, sir, Mr. Bamdeli. So we've seen that we've seen some shift in very recent times as we started the H2 in the rate. So how would you advise our investors? I'm sure investors want to know what approach they should take in terms of asset allocation, considering the recent interest rate shift and the way the economy is, how would you advise investors to, allocate their assets?
Sorry, I didn't realize I had unmuted my mic. So great. So we've alluded at that when I spoke earlier that yes, um, you might find that rates or yields begin to compress further going forward. If inflation is moderated, the Apex Bank would be moved to take a view at the NPR and probably drop it. And once that happens, you find that it takes a toll on the industry. So the idea would be, if you're since we're expecting this to happen, we lock in now so that by the time that kicks in, we're in a good position. So that we're locking now in the fixed income market, we're earning better yields than what might happen in the market in a short space of time to come. So, I mean, that would be the strategy to deploy. Thank you.
Okay, thank you very much, sir. So I'm sure we have some people who, some investors who are bent on, having a long-term value for their investment. So where would you advise, right now, where's the best risk-adjusted opportunities? Where are they emerging from? For clients who want to, minimize their risk and also, rate value, as it were, for their investments, where would you advise that investors start to look at in terms of investing their funds? Like you mentioned, sir, that it is important for investors to take advantage of whatever is happening in the market now. So so what sort of products or would you advise, or investments would you advise that these investors key into?
Okay, thank you for that question. So basically, the question you're asking has to do with, look, investors' appetite, and investors have different appetites. Some investors are more risk averse, some are more risk tolerant. For the risk averse investors, and I would say that, look, what we have in the money markets and the fixed income market, um, I mean, the acceptable levels of returns versus the risk you're willing to take. I mean, you're seeing 16, 15% returns in the money market, and you're very averse to risk, then take that. I mean, it helps you to earn some decent returns, maybe not enough to compete with inflation, but at least to give you peace of mind that, look, my money comes back when it is supposed to come back. Of course, you can consider some commercial papers. Not many of those are in issuance in the market as we speak. A few weeks ago, there were a number of issuances, but that happens per time. You get that at a certain time, and then all of a sudden the market goes quiet in that space. The risk with that is commercial papers are not so liquid. Whatever you're doing as an investor as well, you need to consider the liquidity prospects of whatever investment you're making. If you happen to require liquidity before maturity, how do you exit that position without taking significant discount on what you're doing? Is that all of the question, Debbie?
So sir, I see that someone else has dropped a question on the chat box. I think we'll just take this as our final call for today. So I don't know, either of you or Mr. Ashimi can take this, but if you can, that's fine, sir. So this person wants to thank the speakers for clarity, and he also wants to know what should be our attitude to the equity market in Q1 2026. So he wants to know if they should sell some parts of their portfolios, and he also wants to get some clarity on how effectively it can manage risk in the equity when as we go into the H2. So I'll take that again. So this investor wants to know what the attitude should be for the equity space in Q1 2026. Should they be looking at selling some part of their portfolios? And he also needs clarity on how to effectively manage risk in the equity space this second half of the year 2025.
Let me take some
So
part
let
and
Fatai answer that question.
I know the fund manager will do. No, I mean, on a very, normal day, equity is not a short-term play. It's a long-term play. And if ordinarily you want to come in today and come out tomorrow, you are not supposed to be in the equity market. That is a casino game. Equity market is not a casino game. But because you've been there and you want to take some profit for whatever other alternative investment. Maybe you can once in a while take your profit but it depends on your composition of your portfolio. That's why I said it's always good to actually collaborate with fund manager or probably a stockbroker who can tell you, okay, this is your risk level, and this is your kind of portfolio you can, so that anytime you want to come out, you can offload some and leave some. But don't let us take equity market as if it's a short-term play. It's not a short-term play. It's a very long-term play. And if you can do that, the moment, I have a senior friend. He's retired now. The guy just got retired at 60. His total portfolio by the time he left was about just 60 million naira. And the guy has an average of 15 million dividend every year. What can be better than that? And because he has entered for long, he's not selling those things. But for younger ones, I know, you want to come in and come out. But the moment you think you have actually get to a threshold level, because I don't know what level threshold level of return you actually put target for yourself. For me, when I used to be active in that market, I say any stock I pick and has appreciated by 50%, I will sell. But now, after a point, because of greed in human being, because everything decision you take in life is about greed and fear. The greed in me say, maybe 50% of my target, I've achieved this, let me do more, let it get to 70, let get to 80, let get to 90. That's the greedy part of it. But you are not greedy, I'm out of fear. So just first establish what the threshold you think you are comfortable with. If you mean your stock, by the time you get to 50%, 90, 80% of a particular level, offload, but know that when you are coming in a very early, but there's nothing wrong with you taking profit when you at the appropriate time. But at the back of our mind, please just realize that equity market is not a short-term play, it's a long-term play. And you are really, if you enter well, you can actually make money from it. So I think that would be my, but I don't know when you enter, talk less of telling you go back in Q1 and get out. What happens if somebody's just entering in July? So please, equity is a long-time play, but by and large, establish a threshold before you enter that if whatever equity I invested in, if you get to a level of 50% return appreciation, I will come out, and so be it. So that is a personal decision. Thank you so much.
Thank you very much. That's very insightful. So we have two more questions that I've dropped on the chat box, and I know that we have time against us, but it just goes to show that our attendees are following us as we were speaking. So I want to please ask, so this person wants to ask that are there recommendations and research materials, one that can be shared from the equity markets? I think I can take this. So I don't know if this attendee is an existing investor with us, because you would usually get these emails from our research team if you are an existing investor with us. We usually share this on a daily basis to our existing investors. So and they also wants to know what is the advice stop or loss limit and tenor if one is to play in the equity space. So I don't know if Mr. Adeli wants to take this, or Mr. Fatai. So I'll just quickly run through the second question too. I think this would be better taken by the MD of PAC Asset Management. So someone is asking, for us who stayed conservative and avoided high risk fund in the first half of this year, is it safe to go in for the remaining half of the year? So I don't know if this person still wants to be conservative, or is asking if they should go in for some sort of high risk fund in the second half of 2025. Thank you.
Okay. So I'll answer the last question you raised, and I'll leave the first question for Fatai to answer. And my simple answer is this: I think the train has moved. If you stayed conservative in the first year, and because the market has touched highs that it has not touched before, you want to now get into the market. I think the train has moved, and we always advise investors. The best time to invest in the market is when it is at a low, not when it is at a high. A lot of investors want to join a moving train, and since it started to move, it might be at the top, and then you want to join at that point. What would typically happen once it's reaches a height is it might begin to decline. And if you're buying at the top and it starts to decline, then you're back to square one, where you see this is why I didn't invest in the equities market in the first place. My advice to you would be to be patient and look out for the next rally in the market to invest in. I think it's already late now, except you find some positions based on research that look, we expect to see some movement in this stock, and then you can invest in those stocks. But I mean, buying a stock that is already that moved from 50 naira earlier in this year to 100 naira today, and you think that, oh, because it's going, I want to get in, you might just get bumped. So the advice is you can wait for the next rally, or yeah, begin to prepare yourself now for if there's a correction in the market, and then you get in during the correction low for the next rally. That's my advice. Thank you. So I guess
Thank
Fatai will
you.
take the other question.
Yes. So, Mr. Fatah, do you want me to take the question again, or you are fine?
No, take the question again. I was a bit distracted.
Okay.
What's the question
So,
again?
yes. So this person wants to know, what would they advise? What would you advise as a stop loss limit and tenor if one is to, play in the equity space? What would you advise? Where would you advise the client to, come in or go out or stop? So I know you said something like this earlier, but maybe you might want to reiterate so that you can, get it.
No, I mean, there's no one general rule, I mean, that's applicable to every investors in the equity market. That's what I said. It depends on your risk level. Then two, your risk of, investment objective. If I a long time play, there's no way you do the same time somebody that want to just come in and out and say, okay, 1 year limit. So it depends on where you, but most importantly, don't allow grief to actually overrun your thinking. Because I said put a limit. If you are a type that want to come in and out, set a limit to your target appreciation. The moment that is reached, please exit. You don't, before you to begin to take that kind of decision, you must be a smart investor and somebody that understands the market. Otherwise, the idea is don't go through your fund managers. Just give them money. They have equity fund and they can manage that for you. But if I tell that I want to manage your equity portfolio by yourself, you are somebody that's ready to understand the market, understand all the driver, whether it's fundamental or technical. But if that's the one to play, set a target, target price and appreciation level for yourself. By the time you get to that level, just exit. That's what I advise.
Thank you very much, sir. So, just to add to what Mr. Fatah Hashima said, I'll just retreat on the last part he said about financial advisor, speaking to your financial advisor, and that's one of the things that over here at PAC Asset Management Limited we do. So we offer discretionary and non-discretionary portfolios, where we give clients whether the autonomy to or make these decisions themselves, or you cannot, we help you make these decisions by for you. We work with you. It's something that we like to do. We like to work with you to identify what your risk appetite is, what your risk tolerance is, and want to do. So here we help you execute on these things, and also help you align with your investment goals, so you can be free to reach out to us. You can be sure that when you reach out to us or you come to us with this kind of things, we can help out with it. So it's been a very wonderful session today. We've gained a lot of things from how to navigate the fixed income space, to what to expect in terms of US's diversification, and I'm sure we've also garnered knowledge on practical strategies for rebalancing our portfolio, which I think is one of the main purpose why we thought to put this together. Because if you look at it, maybe we've made some investment mistakes or decisions in H1 2025 that didn't favor us, and as we're going into the half year 2025, we want to begin to rebalance our portfolios. And like I mentioned, PAC Asset Management is here to help you with that. And I want to just admonish us that as we move into the second half of the year, we would like to encourage our investors, would be investors, to take actions. It's very important. At the end of all of this is some sort of call to actions, for you to, schedule strategy calls with your, with your financial advisors. If you're already an investor with PAC Asset Management, you will agree with me that, we are always at your beck and call, when you need to make investment decisions, or, you need to ask, what the market is doing. I mean, we're always available to guide you and put you through. So we want to work with you to revisit your goals, and we want to get as many calls from our investors who have attended this session today, on how you can revisit your investment goals, how we can help you align that, with our various investment strategies. So we'll be dropping our contacts here on the chat, so that you can be able to reach out to us. For those of you, or for those of us who are not yet our investors, you can always go on our website, which is www.pacassetmanagement.com. We'll be dropping that on the chat. You can always reach out to us. Our telephone number will also be dropped on the group chat. I mean, also a replay of this session will be sent, along with what we think are some of the strategies that have been shared. They will be shared with all the participants of this webinar today. Again, we want to say thank you very much for indulging us, for participating in this webinar today, and we hope that you've all had the swell session, a good time, and you've been able to learn one or two, and we can see that from the from the engagements we got in the Q&A session. So thank you very much, and we hope to hear from you. The MD had, mentioned some of our products. We are we are a traditional and contemporary investment business, as it where we delve into whatever it is that you want. We help you align, like I mentioned earlier, your investment goals, the investment strategies that will come up. We have mutual funds, we have wealth management services too for our HNI clients, and we look forward to having you as always. Thank you very much once again, and be blessed, everyone. Thank you.
Thank you everyone for attending. Thank you.